Traders, because of Vinny coming to you from theclosingprint.com, June the 28th, 2020. In this edition of your weekend video newsletter, we'll discuss the indices, all of which moved lower last week. All of our oscillators and indicators are mostly neutral to slightly bearish, while a great many of individual stocks actually look pretty good. The IBD 50 has fewer choices this week, so in my opinion, it's about picking individual stocks and hedging your portfolios in the short term. We only have 2 trading days left in June, and as I've repeatedly mentioned, July is seasonally the strongest month of the year for technology. So this pullback will actually be an opportunity if you have cash in hand. Just know that the heat map is more red now for both the S&P sectors and the international markets. There's a few markets that look better than others. The emerging markets, India, Russia, the Nikkei, and Turkey look the strongest. VWILX is a good choice for international funds in your 401k. Could see a little bit of a pullback, but it's near 52-week highs. In addition, we do have a few IBD 50 names that look good. These are all the stocks that move higher when COVID started being a concern. Some of the MarketSmith relative strength names in white and those in cyan with the blue dot scan, as well as the stocks in green that showed above average volume last week. All of those look pretty good, so make sure you check some of those out as well. We'll review some. And then consider that the Dow Industrials, there's only 2 that look good. Cisco looks the best. Microsoft is okay, but it did pull back a little bit on Friday. Bukowski's got 4 or 5 red with a CPI signal red since June the 9th. It went from 23% down to 11.4%, so that's a move in the wrong direction. It's still bearish. The big changes were 62 stocks look bearish now compared to 29 last week. 8 are bullish compared to 9 last week, and 240 patterns are waiting for breakout compared to 484 last week. So that leaves you with the opinion that there are still stocks out there. We just have to look at them very closely and hedge our portfolios. We're in day trade mode, short-term swings. VIX, again, is key. We need to see the VIX moving lower if you're bullish, and if you're bearish, of course, you want to see that moving higher. That leaves me with the opinion that we should hedge our portfolios. Don't panic, and watch how price action reacts this week near the 50-day moving average. Starting off with SPY, we mentioned this week that the SPY Franco chart, which eliminates the time factor and only looks at price action, gave us a bearish signal. While the signal is bearish, it is only short term. Longer term, you can see that we've been in this uptrend since the reversal on March 23rd. And you can see in the longer term, since the March 23rd lows, we've been making higher highs and higher lows. So we are looking for an opportunity as we go into the seasonally strongest month of the year, July, for technology. So that should help. Tech did look a little bit stronger last week as a sector, so we'll review that in a few minutes. Bottom line, we're on a short-term bearish signal here. If we zoom out to the daily time frame on a candle chart, we can see a large volume by price support zone in this area, along with the 50-period moving average. RSI has moved below 50, so if you've been with us long enough, you know when RSI drops below 50, we have to respect the trend like we did back in February and March. Now, while I'm not looking for the same kind of move lower at the present time, we do feel like the 50-day and this volume by price band will remain support. However, if it doesn't and price action does manage to get through this level, then the next level is that May 13th reversal at 273, give or take. So as an individual investor and trader, we want to see this hold. Otherwise, we'll start hedging on Monday and Tuesday if it looks like we're going to see more weakness into the last 2 trading days of June. while we watch and reassess on a daily basis how the 60-minute time frame responds to an oversold condition. Do we come down to these pivot levels that we saw back here on the 13th, or do we move a bit lower? So until price action tells us what institutions are doing, we're only speculating. If we start moving lower and you are nervous or afraid for whatever reason, then I would suggest hedging. I'll cover some of those potential hedging vehicles in a few minutes. So stick with the analysis and we'll get to that in a minute. NASDAQ 100, the weekly time frame, should be pretty obvious that there's more relative strength here. Note where RSI is compared to the S&P 500. We're above 50, so it says respect the trend. Higher highs and higher lows. Technology does look better as a sector, so we'll cover that when we get to the sectors analysis. For now, it looks like technology is holding up very well. Some would look at this at we're at 52-week highs. If technology starts to fail in addition to the S&P 500, then I would say we probably have an issue and we'll hedge more aggressively and potentially take some bearish positions with puts or with gold or with some other vehicle. For now, this chart is more bullish than bearish at the present time, at highs and above this breakout zone. IWM small caps are a bit more mixed in their view. We're at the 50 level. Price action's been in a range over the last 5 weeks from 135 up to 152. So if we do bounce at this breakout zone around 136, perhaps we can revisit the highs in the short term. Otherwise, we may be coming back down to these lows that we put in at the end of 2018 during the last 20% drawdown. That is a possibility. I don't see it presently, so we should reassess on a daily basis. The Dow Composite is a bit more bearish. This is 65 stocks from the industrials, transports, and utilities group. Industrials and utilities in particular don't look that great, while transports are okay. Again, we'll review that in a second when we look at sectors. If we do lose the moving average here, we have volume by price band as support, so perhaps we come back to that level. That would still give us a bullish condition where we would have higher highs, a new higher low, if we can stay at this level. Then we'd be looking for a bounce and a move back up to the 200 period moving average, the green line overhead. RSI is below 50, so respect the trend. Short term, lower highs, potentially a lower low down to the support zone. The S&P Equal Weight Index also gives us a reason to think that there could be some opportunity in the short term as we sit right on the 50 period moving average and the number of stocks trading above their 50 period moving average dropping, which is actually something that could reverse from what was overbought. If you remember, several weeks ago, we talked about this condition at the red zone potentially being an area where we might reverse a lower high. Now we're looking for a higher low and a bounce. What would give us that? We're about to get a CCI signal. Each time this is triggered, each vertical line gave us an opportunity, 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 opportunity. So there's no reason for us not to believe that if we get a signal on CCI, we are at a condition where the number of stocks trading above their 50 period moving average could turn back up and give us an opportunity as we're not overbought. We're actually at the midline and could give us more fuel for a bounce if shorts have to cover aggressively. From a bearish point of view, we could also get a lot more oversold. So this is a wait and see what happens at the 50-day, the last 2 trading days of June. The Arca Institutional Index, 75 stocks that are most commonly held in institutions' core portfolios, has pulled back below the 21-day, but above the 50-day and the 200-day. We have a oversold stochastic RSI, so there's potential for this oversold condition to give us a reason to reverse in the opposite direction. So watch what institutions are doing with these key 75 stocks. and we'll update you during the live sessions. In addition, if we look at the S&P 1500, a broad measure of market participation, 1500 stocks, no ADRs, no preferreds, no mutual funds. This gives us a cleaner view of the markets with this high-low percent on a cumulative basis, still moving higher, still above the zero line on histogram, but one stick is a caution signal, 3 sticks are a sell signal. However, we can see how we reversed 3 weeks ago on the same signal. So I'm watching how this plays out above this breakout zone, being we're still on a bullish signal and rising above the signal line. If we break down the breadth of those three groups, the S&P 500, mid caps, 400 stocks, small caps, 600 stocks for the S&P, the only one of these three that is below the 200-day is the small cap. So those are underperforming. The other two, though, are above their 200 period moving average. So that's 900 stocks that give us a reason to be more hopeful. If we start to see a lower low on both of these and a test of the 200-day, we'll have to reassess that going into the month of July. For now, though, this is more bullish than bearish in the short term. Another index worth looking at is the New York Stock Exchange, which trades 2,900 stocks on the index. The composite is 2,000 stocks, but for this analysis, what we're looking at is the number of stocks making new highs versus new lows has been making a few less new highs as the black moving average continues to drop. However, we are above the zero line, so net, we're still making more new highs than new lows. We do have the number of stocks advancing during the week versus declining, dropping off a bit. As you saw on the previous 1,500 stocks, the New York Stock Exchange advanced decline unfortunately has a lot of preferred stocks, a lot of ADRs and mutual funds that affect the advanced decline, so it's a bit more skewed. That's why it's better to look at the pure 1,500 stocks on the S&P 1,500 composite versus the NYSE. That said, we are also on the same condition as we saw in the previous chart with 3 red elder sticks like the Arca Institutional Index. We're watching how this breakout zone right in here holds this week. The 200-day is right in that zone, and something we'll be watching this week as we trade into the month of July. Volatility again this week will be the key, as it'll tell you what institutions, dealers, and market makers have to do to hedge their portfolios. They provide the liquidity in the market, so if we get a green signal, that would mean that VIX is actually moving lower. This particular chart gives us a flipped view of VIX to be aligned with the markets. Green is bullish, look for higher highs and higher lows. Red, look for lower highs and lower lows, or a bearish signal. So right now we are neutral. We're just about ready to produce a green signal if it continues higher, which would mean that we'd need to see a lower high in VIX and VIX moving lower. If VIX does start moving lower, that's bullish for the markets going into the month of July. In addition, if we look at the front month VIX versus the 3-month volatility index VXV, this ratio tells us we're in the neutral zone between these two horizontal lines. We're neither very bearish or very bullish. A reason why you should stay calm and hedge if you have anxiety with the markets at the present time. Okay, here's the S&P 500 weekly in the upper panel, the 10-year UST versus the S&P 500 ratio in the lower panel. As this is rising, this is becoming more bearish for investors as bonds become more favorable over equities. Therefore, if you're concerned about the markets moving lower and you want to hedge your portfolio, TLT is one of the investments that many traders will look to. We can see that price action moved through the 50-day last week. RSI is rising, so it's saying respect the trend. The trend is up, higher highs and higher lows. So let's say that you're an individual investor, you're concerned about the markets, you want to hedge. I would look to TLT as one potential investment. We have MACD above its signal line and rising, making higher highs and higher lows, and we have stochastics starting to move into the red zone. So we could run up a little bit more, maybe run into the resistance at 168 or so. But in the short term, more than likely, bonds will continue to move higher if we see any weakness in the S&P on Monday and Tuesday. So this would be a short-term hedge depending on what happens with the markets going into the month of July. Considering what HYG, risk on, risk off indicator tells us, when investors go after high yield corporate bonds, they're taking a little bit more risk on, so they don't mind taking the risk because they feel the markets are supportive. When the markets are not supportive, you'll see HYG starting to move lower. Right now we're producing lower highs. We've yet to see a lower low, though on the weekly we have been producing lower lows on the daily. So we close near the lows of the session. If you're bullish equity markets, you want to see this moving back above the green line, the 65 period moving average. If you're bearish, you want to see this continue to drop. RSI is right at 50, so we don't have a signal yet. It's neutral, starting to turn more bearish in the short term. Another investment in our 401k IRAs that continues to trend higher is AGG. This is the Barclays Aggregate Bond Fund. This is literally the kitchen sink of bonds, collateralized mortgage debt, etc., which Barclays does track with AGG. We have an investment in AGG. It continues to trend since late 2018, where we started to get long. This broke out and continued higher. It's been moving higher. There's no reason to sell it. At present, we had this whippy price action back when the coronavirus first hit. But now if you eliminate these 4 or 5 candles, you definitely see a trend that continues. We are a bit overbought. We could stay overbought. This is producing what we call muscle on stochastic, and MACD is above its signal line. If we had RSI overlaid, you'd see the same thing showing muscle. Short term, this is a decent hedge as well, and something we like having in our portfolio, as it does pay monthly dividends. So if bonds are moving higher, that means yield should be moving lower. We have the 10-year yield here, which most financial media will focus on. We're presently jockeying between 6 and 9, moving lower into this range. If you're bullish for equities, you want to see this moving higher. I would say keep your ears open if you start to see or hear the 10-year yield is moving higher. If you're bullish equities, you want to see this moving higher. We have a bullish crossover from extremes on this oscillator, so if that continues higher, that would be a result of price action moving back to the top of its range. Another area where you would consider hedging, if you're worried about safety, the US dollar is considered a safety trade. It's been making a series of higher lows, looking for a higher high with the 200-day just overhead, MACD crossing. We've got RSI trending towards 50. So if this continues to move higher, that should put pressure on commodities. We'll talk about that in a second. But as far as a hedge is concerned, you could trade this or UUP as a hedging investment. It'd be looking for a move higher. Note that we were recently oversold on RSI. You know that I love this setup. When RSI is oversold, we get a trigger to the upside. Now we have a situation where we have a higher low, looking for a higher high, and with the 50-day just overhead. So if you're thinking of hedges, this is another candidate we're considering as well. Watching the British pound US dollar below the 21-day moving lower, which is generally considered bullish for the London Stock Exchange and the FTSE. As you can see, price action on the daily moving back above the 21-day in something of a range over the last 6 weeks, 5 weeks. Descending channel, looking for a breakout. If we do see a follow-through on the British pound US dollar to the downside, for those of you trading on the FTSE or the London Stock Exchange, you should see higher prices in those two indexes. US dollar Japanese yen pair starting to move a bit higher, which would indicate the US dollar is outperforming the Japanese yen, which in turn would mean that if you're trading in the Japanese index, the Nikkei, you should be looking for higher lows. We got that. 21-day has held. So this is another area where you can invest. Even in your 401k, some 401ks give the ability to invest in international funds. The Nikkei is moving a bit higher. Just see what the weighting and the different international indices are on the fund that you might be interested in, as the Nikkei could be a large component and something you would like to see when the US dollar Japanese yen is moving higher and the yen is moving lower. Looking at commodities for a moment, when you're thinking about leading economic indicators, many people will look at copper, which is continuing its production of higher lows and higher highs. It broke through this resistance zone and now it's above. So any pullback would probably be supported, which would indicate that the construction related names, builders, and construction materials, home improvement names should continue higher at some point. So if we look at this group, what we would be most interested in are those stocks that are remaining above the 21-day, like GNRC. This also tends to outperform Generac generators during the hurricane season, which we're entering. We also want to see stocks in the builder group continue to hold these levels. Most of them are near the 21-day and above the 50-day. So pause the video and write that down. If home builders and copper start moving higher this week, these might be an opportunity as well. Some of these are pulling back to the 50-day. So rather than thinking, oh gosh, I have to sell, look at this as an opportunity. Just pull back. We want to buy the pullbacks. We don't want to be fearful of the pullback. So if copper continues to move higher, look at this group of stocks as a potential for a buy. And remember, they need to show and prove they're going to bounce first. So look for the first couple of days of bullish action. Look for a follow through off the 21-day or the 50-day if you're thinking about trading some of these builders or home improvement stocks. Listen up again. If you're thinking about hedges, this is another opportunity. Safety trade, a hedge in times of uncertainty. Gold is starting to move higher. It's at the top of its range. We did start a small position in GLD. September calls, I believe Russell mentioned. Late Friday, we decided to join him. Bought a few calls out in September. Looking for this to move higher. So gold, you can just look at GLD. Same thing we were looking at. Potential breakout here as another vehicle for a hedge if you're thinking about a safety trade. Higher highs, higher lows, breaking out above an area of no overhead supply. RSI is above 50. Respect the trend. MACD is above the signal line and volume increasing. However, all things considered, West Texas crude and Brent crude are positively correlated to the equity markets, meaning if this continues higher, you would expect to see equities moving higher as well. It's not a guarantee, but it's one thing where we mentioned that our indicators and oscillators are neutral to bearish. This is one of those neutral indicators where if we do see a breakout, that would be bullish for equities. If we saw a breakdown out of this 10, 11 week reversal up over 545%. So watch your commodities, potentials for hedges, and for indicators if West Texas crude moves higher or lower this week. Our sector heat map, reading from left to right, we can see that each week on Friday this is updated. It's a visual cue to market strength or weakness. As you can see, back here in January into February, we had lots of red, gradually moving to green in March. This gave us a heads up to start positioning more long. The reversal in the markets came March the 23rd. You can see how things started to improve markedly. Now we're here back in the end of June. Our last update gives us more reds and oranges, both for the S&P 500 sectors and for international indices. So we want to see, if you're thinking bullish, you want to be looking at the groups that are more yellows and lime greens, hopefully greens in the near future. Emerging markets looking a little better. Just look at the opening monologue I already highlighted strength in some areas like India and Russia and Turkey to persist going into this week. Emerging markets also looking okay for an investment trading near highs. We're also looking at the individual sectors that are holding up better than others. Obviously, communications, XLC, big drop last week. Facebook's a big component. It had a really bad week. Technology holding up the best. Again, we talked about how technology looked okay compared to the other sectors going into the seasonally strongest month of the year. So I can't emphasize this enough that technology actually looks pretty decent. Just like the NASDAQ 100, where are we? We're at 52-week and all-time highs. We have several layers of support down below with a major level of support at 80. I don't think we're coming that far back. Technology most likely will continue higher. Where is RSI? Above 50. That says respect the trend. Though we don't think that we're going to go straight up, we could pull back and find support at the moving averages before moving higher with no major distribution like we saw back in March or in February. MACD is above its signal line and rising, which is telling you on a weekly basis, momentum is going to take a couple of weeks to shift. We might have already started to see that with these wicks up high. So keep an eye on technology this week and don't shy away. Look for opportunity. Finally, I'll leave you with this thought. When you take the ratio of consumer discretionary, things that consumers do not need, hence discretionary, versus consumer staples, things that families need, people need to buy these staples, when the former is outperforming the latter, you see a bullish trend. So this is one of those indicators that's more hopeful. It's definitely more bullish, telling you what institutions are actually doing. They're buying more of the consumer discretionary and less of the staples. So this indicator will continue to move higher like it did back in late 2018, early 2019, which started the bullish run into the January, February highs this year after COVID came in and we started to see this roll over. So the bottom line is this is something to look more hopeful. If this starts to turn rapidly for some reason, it'll show up in the sectors and individual stocks as well. So the takeaway is don't be so fearful, don't be panicked, just hedge if you have concerns in the market using the vehicles and candidates we've reviewed thus far. Here is the IBD 50 list. Most of these you can see don't look that great. AMD dropped off dramatically on Wednesday, Thursday, and Friday. Many stocks are pulling back, which could be an opportunity. Adobe is showing a lot of strength, while stocks like Box continue to move higher. That's why we are looking at this one as a potential trade this week, holding up fairly well. Box, you have RSI above 50, price moving above the 9 EMA. You have this large volume by price support zone just below. So risking $1, you could see $2 upside, maybe more. Volume increasing on Friday, MACD above its signal line and rising, making this a nice candidate for a follow-through this week. If it starts off the day on Monday, even if the markets are moving a bit lower, keep an eye on it. Might be a nice opportunity. We will as well. Going into the seasonally strongest month of the year, July, for technology, which this is in the middle of, in the cloud and storage industry group. Chegg is also looking very strong. Purveyor of books and materials for students online as well as printed materials, holding up very well at the 9 and 21 day. So if we see a bullish follow-through day start on Monday, that could indicate that we're going to stay above these volume by price bands and trade into an area overhead where there are a few sellers, there's little supply, potentially test 70.57, RSI is above 50, volume increasing, showing institutions were picking up shares. They like what they see as well, and MACD is above its signal line. Dynatrace has been on the IBD 50 for a couple of weeks. This company develops software intelligence platforms for allowing customers to modernize and automate their IT operations. So this is looking good. Just gave us a little pullback to the 9 EMA. So this is potentially looking for a follow-through. You have a good support risk reward level right here at 41. So with the stop just below Friday's low, if we start to see price action moving higher, you can trail that stop and use the opening range as price action starts to move higher into Monday and Tuesday, the last 2 trading days of June. So we like Dynatrace. We just need to see evidence buyers will step up as well on Monday, Tuesday. To reiterate, gold looks strong. It may break out this week as a safety trade. If it does, Franco Nevada is perfectly set up right at the 21-day moving average. Tested the 50-day on Friday, closed above. RSI is above 50. If we move above these areas over here on volume by price, there's no overhead supply. Looks like it's creating a shallow cup pattern with 152 as your target. Volume should pick up, which would indicate institutions are picking up shares. MACD is already above its signal line, having crossed last week. Looking for a follow-through this week in Franco Nevada. Neurocrine Biosciences, NBIX. Follow-through, tested the 9 EMA Wednesday and Thursday, followed through in an area where we could see no overhead supply and a breakout this week. RSI is above 50. Volume showing institutions were picking up shares. MACD is above its signal line, indicating the bulls are in control. Look for NBIX to follow through this week, especially if healthcare and biotech continues to move higher. I failed to mention that biotech looks very strong this week, especially XBI, which did pull back to the 9 EMA on Friday, but it's in an area where it could conceivably test the breakout zone. RSI is still above 50. Watch NBIX and biotechs in particular this week. While the media becomes more negative, look for this to follow through and continue higher with a target of around 26, 27. Depth of the pattern is about 3 or 4 points. So the measured move on a breakout would be about 30 to 31, maybe 32, stretching it, with RSI rising, suggesting there's more upside before we run into resistance. Those resistance levels would be 2605 and 2683 as RSI continues to move higher, rendering a nice setup on Sprouts Farmers Markets this week. Workday is one of the last stocks on the IBD 50 we'll review this week that looks very similar, bouncing at the 21-day on Wednesday, followed through Thursday with a bullish engulfing candle. Followed through again on Friday, buyers stepping up at the low of the day, showing relative strength when the markets were moving lower. This was moving higher. Look for Workday, a company that provides enterprise cloud-based applications for finance and human resources. At some point, people will be hired again. This company is benefiting from that. So look for a follow-through in Workday with a test at 202 potentially. That's a profit zone on this MarketSmith chart, as you can see in green, with the stock moving higher on above average volume. Relative strength line is climbing as well. Note the increasing sales and earnings going into 2021 and 2022 with excellent IBD metrics. Additional stocks that we're watching from the relative strength scan. This looks for stocks that are showing relative strengths when the markets are in a correction. So relative strength line climbing, new highs with a market in correction. So some of the stocks that are on this are AbbVie, BioMarin Pharmaceuticals, Cadence Design Systems, about to break out, DocuSign, deals still need to get done. We're thinking about selling our house, putting it up on the market, and moving to Myrtle Beach in the short term. So there's a possibility if things get worse in New Jersey or New York that a lot of documents, closing documents, might get signed using this facility. DocuSign is breaking out on above average volume. Last earnings was a beat of 71%. Note sales and earnings are increasing and handsome IBD metrics. Electronic arts, this is an area where I would suggest there's a lot of potential. Electronic arts, ATVI, all of these gaming software companies are seeing big sales online. I know my son spent over $200 on games in the last 4 months because of this whole COVID-19 thing, being at home, hunkering down. between software and a Nintendo Switch that he absolutely had to have. We also see Take-Two Interactive, another one. All of these showing a very similar pattern. I like Take-Two the best out of these, with EA and ATVI all showing relative strength as well. Electronic Arts looks pretty good this week too if we get a bounce on Monday and Tuesday. Note earnings are a ways out, so you have plenty of time. eBay also showing relative strength. Think about it. People trying to make ends meet. They're selling things that they don't need on eBay, Craigslist, yard sales, whatever, just to make ends meet. eBay looks pretty good for a breakout. Match.com, I know Rob was looking at this one last week as well. It finally broke out on Friday on above average volume. Think about it. If you were single, you're probably going stir crazy if you're having to stay home, whether it's in California or in New York or New Jersey, where the states are a lot more restrictive. It makes sense that sales and earnings will continue to increase. Very nice IBD metrics as well, with 90s and A's and B pluses. Looks very nice with a growth rate of 30%. That's pretty huge. In addition, if we look at the number of firms adding to their portfolios, you can see an increase with no decreases in the last 2 years. We have percentage held by management 3%, 75% by funds. So I can tell you that while not a guarantee, this does look pretty good for Match.com. NTES also looks good. Last week we also traded Cadell. That one's moving higher, breaking out. Depth of the pattern, about 50 points on top of this, so 260 ultimately. It won't be a straight shot, but that is the potential. There's no guarantees. Everything could fall apart, obviously, this week. Just use that as a potential measured move over the next several months. Cadell develops rapid diagnostic tests for infectious diseases. This should continue higher as the media continues the drumbeat of COVID into the weeks and months ahead. Additional stocks we look at, if you go to the Market Smith Blue Dot Scan, this has got a few names that look pretty decent as well. If we look at AMRC, I believe is on here, AMRC. We're looking at the relative strength line in these cases. Blue Dot Scan. Company provides upgrading services for energy infrastructure construction, operates small-scale renewable energy plants. Remember the copper index, how that continues to move higher. That's telling you, economically speaking, some of these stocks will continue to move higher as well. Bill.com, we talked about this over the last couple of weeks. That's why it was on the watch list. Relative strength line climbing. Blue Dot Scan, it shows up here. Looking for a follow-through on above average volume. This company provides cloud-based software that simplifies, automates back-office financial operations. That's for small businesses. That makes sense when you think about it. You're having to pay people that are on your payroll, like IBD. They pay their consultant, writers, etc. I also do some work for IBD as a consultant, and they have to pay us somehow. So how do they do that? They automate it with companies like Bill.com. Makes sense. ELA looking good on the Blue Dot Scan. EMX looking good. These were on the Blue Dot Scan a couple of days ago, so they don't have the blue dot, but you can see relative strength line is climbing. TTGT, Tech Target, relative strength line climbing. Recent pullback to the 21-day, looking for a bounce and a follow-through. Additional stocks on the 100% volume screen. These are stocks that move higher on above average volume. They are the stocks that are highlighted in green. All right, so all of these stocks look like they could follow through. So be sure to check these stocks out as well with the same mindset. Is it above the 9 and 21 day? Yes. Is RSI above 50 and trending higher? Yes. Is MACD above a signal line and rising? Yes. Look for these stocks in green to also move higher. Traders are taking these to new highs on above average volume. Okay, traders, that's going to do it for me. This is Cousin Vinny coming to you from theclosingprint.com, June 28th, 2020, with your weekend video newsletter. I'll send out the watch list later tonight around 11, 11:30, 8, 8:30 on the West Coast. It might be a little bit late, dealing with a lot of issues around the house with this COVID-19. having to help the wife a lot more. Bottom line, everybody's dealing with the crisis. We have to watch what the S&P 500 is doing, reassessing this week. If you're nervous, go back into the tape, look at the bonds, look at the gold stocks, look at the hedges that we outlined. You can start hedges. I wouldn't go crazy on your portfolio. Just take enough of a position that it'll cushion any downside that you might experience in the next few days, and we'll update you during the live broadcast. Take care. I hope this helps, and we'll talk to you soon.